Bitcoin mining is the process that creates new bitcoins. It involves using specialized computers to solve complex mathematical problems. These problems are part of the Bitcoin protocol and are designed to be difficult to ensure that new bitcoins are created at a predictable and controlled rate. The process is called mining because it is similar to mining for precious metals like gold, where effort and resources are expended to extract something valuable. Unlike traditional currencies, which central banks print, Bitcoin is not controlled by any single entity. Central banks can print money at will, which can lead to inflation and devaluation of the currency. In contrast, Bitcoin has a fixed supply of 21 million coins, which makes it deflationary by nature. This means that over time, as more people use Bitcoin, its value is likely to increase. Bitcoin relies on a decentralized network of computers to generate new coins. This network is made up of thousands of computers, known as nodes, that work together to maintain the Bitcoin blockchain. The blockchain is a public ledger that records all Bitcoin transactions. Because the network is decentralized, it is more secure and resistant to attacks compared to centralized systems. Miners use powerful computers to solve complex mathematical problems. These problems are known as proof of work and require significant computational power to solve. The miners compete to be the first to solve the problem, and the winner gets to add a new block of transactions to the blockchain. This process ensures that the blockchain remains secure and that new bitcoins are created in a fair and transparent manner. These problems are designed to be difficult and energy-intensive to solve. This is intentional to prevent any single miner or group of miners from gaining too much control over the network. The difficulty of the problems adjusts over time based on the total computational power of the network, ensuring that new blocks are added approximately every 10 minutes. The first miner to solve the problem adds a new block of transactions to the blockchain and earns a reward in Bitcoin. This reward is known as the block reward, and it halves approximately every 4 years in an event known as the halving. The block reward started at 50 bitcoins and is currently 6.25 bitcoins as of 2020. This mechanism ensures that the total supply of Bitcoin remains limited. This reward is the incentive for miners to contribute their computing power to the network. Without this incentive, miners would have little reason to spend the time and resources needed to mine Bitcoin. The reward system ensures that the network remains secure and that new Bitcoins are created in a controlled and predictable manner. As the block reward decreases over time, transaction fees are expected to become a more significant source of income for miners. Think of Bitcoin mining like a global competition. It's a race where participants from all over the world compete against each other. These participants, known as miners, use powerful computers to try and solve a complex mathematical puzzle. The puzzle is not just any ordinary puzzle, it requires immense computational power and sophisticated algorithms to crack. Miners around the world race to solve a complex puzzle. This puzzle is part of the Bitcoin protocol and is designed to be difficult to ensure that it cannot be solved too quickly. The miners use specialized hardware known as mining rigs, which are optimized for this task. These rigs consume a lot of electricity and generate a significant amount of heat, requiring cooling systems to keep them operational. This puzzle requires a significant amount of computational power to solve. High-performance computers, often housed in large data centers, work tirelessly to find the solution. These data centers can be located anywhere in the world, from Iceland to China, wherever electricity is cheap and cooling is efficient. The computational power required is measured in hashes per second, and the more hashes a miner can compute, the higher their chances of solving the puzzle. The first miner to solve the puzzle gets to add a new block of transactions to the blockchain. This blockchain is a digital ledger that records all Bitcoin transactions ever made. Adding a new block to the blockchain is a significant event because it confirms the transactions and makes them immutable. The miner who adds the block is rewarded with newly created Bitcoins and transaction fees from the transactions included in the block. This process is how new Bitcoins are created and added to the circulating supply. Each time a new block is added, a certain number of new Bitcoins are generated. This is the only way new Bitcoins come into existence, and it is designed to be a controlled and predictable process. The reward for adding a block is halved approximately every 4 years, in an event known as the halving, which ensures that the total supply of Bitcoin is capped at 21 million. The difficulty of the puzzle adjusts automatically. This adjustment happens every 2016 blocks, or roughly every 2 weeks. The goal is to ensure that blocks are added to the blockchain at a consistent rate, approximately every 10 minutes. If more miners join the network and the total computational power increases, the difficulty of the puzzle increases. Conversely, if miners leave the network, the difficulty decreases. This ensures that it takes approximately 10 minutes to mine a new block, regardless of how much computing power is dedicated to mining. This 10-minute interval is crucial for the stability and security of the Bitcoin network. It allows time for transactions to propagate through the network and be verified by other nodes, ensuring that the blockchain remains a reliable and tamper-proof record of all transactions. Section 5. The significance of Bitcoin mining. Bitcoin mining is crucial for the security and integrity of the Bitcoin network. Miners act as auditors, verifying and validating transactions. They ensure that all transactions adhere to the rules of the Bitcoin protocol. This process prevents fraud and double spending. Double spending is the risk of spending the same Bitcoin twice. Bitcoin mining makes this practically impossible, ensuring the trustworthiness of the Bitcoin network. This trust is essential for Bitcoin to function as a viable form of money. Section 6. Decentralization and security, the pillars of Bitcoin. Decentralization is a core principle of Bitcoin. Bitcoin mining is essential for maintaining this decentralization. Since anyone can become a miner, no single entity can control the network. This distributed nature makes Bitcoin resistant to censorship and manipulation. Governments or financial institutions cannot shut down Bitcoin. Transactions cannot be blocked or reversed. This makes Bitcoin a powerful tool for financial freedom and independence. Section 7. Environmental impacts of Bitcoin mining. Bitcoin mining requires a substantial amount of energy. This is due to the computational power needed to solve the complex mathematical problems. The energy consumption of Bitcoin mining has raised concerns about its environmental impact. However, the Bitcoin network is becoming more energy efficient. Miners are increasingly using renewable energy sources like solar and wind power. Additionally, technological advancements are leading to more efficient mining hardware. Section 8. Real-world applications and examples. Bitcoin and its underlying blockchain technology have the potential to revolutionize various industries. One prominent example is in supply chain management. Companies can use blockchain to track goods and products throughout their entire lifecycle. This transparency can help improve efficiency, reduce fraud, and enhance trust among stakeholders. Other potential applications include secure online voting, digital identity management, and cross-border payments. Section 9. Conclusion. Bitcoin, mining, and the future. Bitcoin mining is an integral part of the Bitcoin network. It secures the network, ensures its decentralization, and creates new Bitcoins. While it faces challenges, such as its environmental impact, the future of Bitcoin mining is promising. As technology evolves and awareness grows, Bitcoin mining is likely to become more efficient, sustainable, and widely adopted. Understanding Bitcoin mining is essential for comprehending the transformative potential of cryptocurrencies and the future of finance. Bitcoin mining, once seen as a simple equation of processing power and Bitcoin's value, has undergone a profound transformation. The industry is no longer solely tethered to the fluctuations of the cryptocurrency market. Instead, a confluence of factors now dictates the profitability and feasibility of mining operations. Technological advancements play a pivotal role, driving efficiency and reducing energy consumption. Sustainability concerns have taken center stage, prompting a shift toward renewable energy sources. Governments worldwide are flexing their regulatory muscles, imposing stricter rules on this evolving industry. These factors, combined with the inherent volatility of the cryptocurrency market, create a complex and dynamic landscape for Bitcoin miners. Understanding these interconnected elements is essential for comprehending the future trajectory of this rapidly evolving industry. The days of individual miners operating out of their basements are fading into memory. Today's mining landscape is dominated by large-scale industrial operations, often located in regions with abundant and affordable energy sources. As the industry matures, adaptability and a keen understanding of the evolving economic, technological, and regulatory landscape are paramount to success. The latter half of 2024 offered a welcome respite for Bitcoin miners who had weathered a turbulent period. Bitcoin's price, a key determinant of mining profitability, experienced an upward trend, injecting a much-needed dose of optimism into the market. Concurrently, energy costs, a major operational expense for miners, showed signs of stabilization, further bolstering the economic outlook for the industry. This period of relative calm, however, was not without its challenges. Hash rate, a measure of the total computational power dedicated to mining Bitcoin, remained relatively stable, indicating intense competition among miners for a slice of the pie. Mining difficulty, the algorithm's way of adjusting the challenge of mining new blocks, also remained steady, keeping miners on their toes. Despite these challenges, the improved economic conditions in late 2024 provided a much-needed lifeline for many miners. It underscored the resilience of the industry and its ability to adapt to changing market dynamics. However, the inherent volatility of the cryptocurrency market and the ever-present regulatory uncertainties serve as stark reminders that the road ahead for Bitcoin mining is unlikely to be smooth. The relentless march of technology continues to reshape the landscape of Bitcoin mining. Mining hardware, specifically application-specific integrated circuits or ASICs, has become exponentially more powerful and energy efficient. These specialized chips are designed for the sole purpose of mining Bitcoin, offering significant performance gains over traditional computing hardware. Software advancements also play a crucial role in optimizing mining operations. Sophisticated algorithms are employed to manage energy consumption, maximize hash rate output, and monitor the health of mining equipment. These software solutions are essential for miners seeking to gain a competitive edge in a fiercely competitive market. The drive for technological innovation in the Bitcoin mining industry is fueled by several factors. First and foremost is the need to improve efficiency and reduce operational costs, particularly energy consumption. Second, as environmental concerns gain prominence, the industry is under increasing pressure to adopt more sustainable practices. Technological advancements are seen as key to addressing these challenges and ensuring the long-term viability of Bitcoin mining. A profound shift is underway in the Bitcoin mining industry, driven by a confluence of environmental concerns, regulatory pressures, and the pursuit of long-term sustainability. This transformation centers around the adoption of renewable energy sources, such as solar, wind, and hydroelectric power, to fuel the energy-intensive process of mining Bitcoin. The environmental impact of Bitcoin mining has been a subject of intense scrutiny and debate. Critics argue that the industry's reliance on fossil fuels contributes significantly to greenhouse gas emissions, exacerbating climate change. In response, there is a growing movement within the industry to embrace cleaner and more sustainable energy sources. This transition is not without its challenges. Renewable energy sources can be intermittent, subject to fluctuations in weather patterns. This unpredictability poses challenges for mining operations that require a constant and reliable supply of electricity. However, advancements in energy storage technologies, such as battery systems, are helping to mitigate these challenges, paving the way for a greener future for Bitcoin mining. Section 5. Navigating the Regulatory Maze, a Global Perspective. The regulatory landscape for Bitcoin mining is as diverse and dynamic as the cryptocurrency itself. Governments worldwide grapple with regulation, from bans to cautious embrace. This creates opportunities and challenges for miners navigating complex rules. China's crackdown has shifted mining to North America, Central Asia, and Northern Europe. Countries like El Salvador court miners with incentives and renewable energy. Miners must stay informed and adapt to the fluid regulatory landscape. Section 6. Wall Street enters the fray, institutional investment and market dynamics. The world of Bitcoin mining is no longer the exclusive domain of tech-savvy individuals and early adopters. Institutional investors, including hedge funds, asset management firms, and even publicly traded companies, have recognized the potential of this rapidly growing industry and are injecting significant capital into mining operations. This influx of institutional money has brought about several notable changes to the Bitcoin mining landscape. First, It has increased the scale and sophistication of mining operations. Large, well-funded companies now dominate the industry, often operating vast mining farms with thousands of ASIC miners. Second, institutional investment has brought greater financial stability to the sector, reducing reliance on volatile retail investment. However, this stability comes at a cost. Institutional investors often bring with them a more risk-averse approach, which can stifle innovation and slow down the adoption of new technologies. The interplay between institutional investment and the inherent volatility of the cryptocurrency market continues to shape the dynamics of the Bitcoin mining industry. Section 7. Bitdeer Technologies, a case study in adaptation and resilience. Bitdeer Technologies, a prominent player in the Bitcoin mining industry, exemplifies the challenges and opportunities that come with operating in this rapidly evolving sector. The company has demonstrated a remarkable ability to adapt to changing market conditions, embracing technological advancements and exploring new avenues for growth. Bitdeer has invested heavily in state-of-the-art ASIC miners, optimizing its mining operations for maximum efficiency and profitability. Recognizing the importance of sustainability, the company has also made strides in incorporating renewable energy sources into its energy mix. However, Bitdeer has also faced its share of challenges. The company has had to navigate the volatile cryptocurrency market, which can significantly impact mining profitability. Additionally, Bitdeer has had to contend with the ever-changing regulatory landscape, ensuring compliance with evolving rules and regulations in various jurisdictions. Despite these challenges, Bitdeer's experience highlights the importance of adaptability, innovation, and a commitment to sustainability for success in the Bitcoin mining industry. Section 8. The Road Ahead: Collaboration, Innovation, and the Sustainability Imperative. The future of Bitcoin mining hinges on collaboration, innovation, and a steadfast commitment to sustainability. As the industry matures, we can expect to see closer partnerships between mining companies and energy providers. These collaborations will be essential for securing access to reliable and affordable energy, particularly from renewable sources. Innovation will continue to drive the industry forward, with advancements in mining hardware and software leading to greater efficiency, reduced energy consumption, and enhanced profitability. Artificial intelligence and machine learning are poised to play an increasingly important role in optimizing mining operations, from energy management to predictive maintenance. Sustainability will be non-negotiable for the Bitcoin mining industry's long-term viability. Embracing renewable energy sources, reducing carbon emissions, and exploring innovative solutions for minimizing environmental impact will be paramount. The industry must demonstrate its commitment to responsible and sustainable practices to gain wider acceptance and ensure its continued growth. Section 9. Challenges on the Horizon: Volatility, Regulation, and the Need for Constant Evolution. The Bitcoin mining industry faces significant challenges. Market volatility threatens profitability and disrupts plans. Regulatory uncertainty casts a long shadow. New rules could disrupt operations and increase costs. Constant evolution is crucial for survival. Rapid tech advancements require continuous upgrades. Falling behind means being outpaced by competitors. The industry demands adaptability and innovation. Bitcoin has captured the world's attention as digital gold, a revolutionary form of currency that exists entirely in the digital realm. Unlike traditional currencies, Bitcoin is not controlled by any central authority, making it a decentralized and secure form of money. This digital gold is stored in secure digital wallets and operates on a technology known as blockchain. Blockchain is a distributed ledger that records all Bitcoin transactions across a vast network of computers. But behind the scenes, a crucial process called mining ensures Bitcoin's integrity and security. Mining is the backbone of the Bitcoin network, a process that involves solving complex mathematical problems. Imagine a global network of computers working tirelessly to validate and record Bitcoin transactions. These computers are part of a decentralized network that spans the globe, ensuring that no single entity has control over the entire system. These computers are operated by miners, the unsung heroes of the Bitcoin ecosystem. Miners are individuals or organizations that contribute their computing power to the network. Miners play a vital role in maintaining the Bitcoin network. They ensure that transactions are verified and added to the blockchain, keeping the system secure and operational. They contribute their computing power to solve complex mathematical problems. These problems are designed to be difficult to solve but easy to verify, ensuring the integrity of the network. This process, known as mining, is essential for verifying and adding new transactions to the Bitcoin blockchain. Each time a problem is solved, a new block is added to the blockchain, and the miner is rewarded with newly minted Bitcoin. Without miners, Bitcoin transactions would not be validated. The network relies on these miners to maintain its decentralized nature and ensure that all transactions are legitimate. The network would grind to a halt, and the security and immutability of Bitcoin would be compromised. This would undermine the very foundation of what makes Bitcoin valuable and trustworthy. In the following sections, we will delve deeper into the intricacies of Bitcoin mining. We will explore the technical mechanisms that make mining possible and the economic incentives that drive miners to participate. We will also examine the challenges faced by miners, including the increasing difficulty of mining and the environmental impact. Finally, we will look at the potential future developments in the world of cryptocurrency mining and what they could mean for the future of Bitcoin. Imagine a global competition where participants race to solve a complex puzzle. The first one to find the solution gets rewarded. This analogy captures the essence of Bitcoin mining, albeit in a simplified manner. In the world of Bitcoin, miners compete to solve cryptographic puzzles. These puzzles are designed to be computationally intensive, requiring significant processing power. The first miner to solve the puzzle gets to add the next block of transactions to the Bitcoin blockchain. This process of adding blocks to the blockchain is crucial for maintaining the integrity and security of the Bitcoin network. Each block contains a record of confirmed transactions, and once added to the blockchain, these transactions become immutable and tamper-proof. At the heart of Bitcoin lies the blockchain, a revolutionary technology that serves as a public ledger for all Bitcoin transactions. Imagine a digital record-keeping system that is transparent, secure, and accessible to everyone. The blockchain is essentially a chain of blocks, with each block containing a set of validated transactions. These blocks are linked together chronologically, forming an unbreakable chain of information. Miners play a crucial role in maintaining the blockchain. They verify and add new blocks to the chain, ensuring that all transactions are legitimate and recorded accurately. The decentralized nature of the blockchain, distributed across a network of computers, makes it incredibly secure and resistant to tampering. Proof of work, or POW, is the consensus mechanism that underpins Bitcoin's security. It ensures that only valid transactions are added to the blockchain and that the network remains resistant to attacks. In simple terms, POW requires miners to expend computational effort to solve the cryptographic puzzles mentioned earlier. The solution to these puzzles serves as proof that the miner has invested significant resources in securing the network. This mechanism makes it extremely difficult and costly for malicious actors to manipulate the blockchain. The computational power required to alter the blockchain would be astronomical, deterring potential attackers. Section 5. Mining rigs, the hardware behind the hustle. Bitcoin mining requires specialized hardware called mining rigs. These rigs are the backbone of the Bitcoin network, performing the essential task of validating transactions and securing the blockchain. These rigs are essentially powerful computers designed to perform the complex calculations necessary for solving cryptographic puzzles. The more powerful the rig, the more calculations it can perform, increasing the chances of earning Bitcoin rewards. Early Bitcoin miners could mine using their personal computers, but as the network grew, the difficulty of mining increased significantly. This meant that the computational power required to mine Bitcoin also increased, making personal computers obsolete for this purpose. This led to the development of specialized mining hardware, such as ASICs, or application-specific integrated circuits. These devices are custom-built to perform the specific task of Bitcoin mining with maximum efficiency. ASICs are designed specifically for Bitcoin mining and offer significantly higher hash rates, which is a measure of their processing power. The higher the hash rate, the more calculations a mining rig can perform per second. The higher the hash rate, the more calculations a mining rig can perform per second, increasing its chances of solving the puzzle and earning Bitcoin rewards. This evolution in hardware has made Bitcoin mining a highly competitive industry, where only the most efficient and powerful rigs can succeed. Today, large-scale mining farms with thousands of ASICs are common, each rig working tirelessly to secure the network and earn rewards. The hardware behind the hustle is a testament to human ingenuity and the relentless pursuit of technological advancement. Section 6. Mining pools, joining forces for greater rewards. As the difficulty of Bitcoin mining increased, individual miners found it increasingly challenging to compete with larger mining operations. This led to the emergence of mining pools. Mining pools allow individual miners to combine their computing power and work together to solve blocks. By pooling their resources, miners increase their chances of earning Bitcoin rewards. When a mining pool successfully mines a block, the rewards are distributed among the participants based on their contributed hash rate. This collaborative approach allows smaller miners to earn more consistent rewards compared to mining solo. Section 7. Energy consumption, the environmental debate. Bitcoin mining's energy consumption has been a subject of debate and scrutiny. The computational power required to secure the network consumes a significant amount of electricity. Critics argue that this energy consumption is unsustainable and contributes to environmental problems. However, proponents argue that Bitcoin mining incentivizes the development of renewable energy sources and can utilize excess energy that would otherwise be wasted. Efforts are underway to develop more energy-efficient mining hardware and explore alternative consensus mechanisms that consume less energy. The environmental impact of Bitcoin mining remains a complex issue with no easy answers. Section 8. Mining difficulty. Adapting to the competition. Bitcoin's mining difficulty is a dynamic parameter that adjusts based on the total hash rate of the network. It ensures that the average time to mine a block remains relatively constant, around 10 minutes. As more miners join the network and the total hash rate increases, the mining difficulty adjusts upward, making it more challenging to mine a block. Conversely, if miners leave the network and the hash rate declines, the difficulty adjusts downward. This self-regulating mechanism ensures the stability and security of the Bitcoin network. Section 9. The future of Bitcoin. Mining, innovation, and sustainability. The future of Bitcoin mining is likely to be shaped by innovation and a focus on sustainability. As the demand for cryptocurrencies continues to grow, so does the need for more efficient and environmentally friendly mining solutions. This has led to a surge in research and development aimed at creating technologies that can reduce the carbon footprint of mining operations. Researchers and developers are constantly exploring new technologies and approaches to improve the efficiency and environmental friendliness of mining. From advanced cooling systems to innovative software algorithms, every aspect of the mining process is being scrutinized for potential improvements. These efforts are not just about reducing energy consumption but also about making the entire process more sustainable in the long run. One area of exploration is the development of more energy-efficient mining hardware. This includes the creation of specialized chips and circuits that can perform mining tasks with significantly less power. These advancements are crucial for reducing the overall energy consumption of mining operations, making them more sustainable and cost-effective. Another area of research is the exploration of alternative consensus mechanisms, such as proof of stake, which consume significantly less energy than proof of work. Proof of stake offers a promising solution to the energy-intensive nature of traditional mining methods, potentially transforming the way cryptocurrencies are mined and maintained. Furthermore, there is growing interest in using renewable energy sources to power Bitcoin mining operations. Solar, wind, and hydroelectric power are being increasingly considered as viable options to reduce the environmental impact of mining. These renewable energy sources not only help in cutting down the carbon emissions, but also make mining operations more sustainable and resilient to energy price fluctuations. As the industry matures, we can expect to see continued innovation and a greater emphasis on sustainable mining practices. The future of Bitcoin mining will likely be defined by a balance between technological advancements and environmental responsibility, ensuring that the growth of the cryptocurrency market does not come at the expense of our planet. Bitcoin is a digital form of money. Unlike traditional currencies which are issued by governments and central banks, Bitcoin is created and managed electronically. It exists only in the digital world and is not tied to any physical form like coins or paper bills. Imagine it like electronic cash for the internet. You can use Bitcoin to buy goods and services online, transfer money to friends and family, or even invest in it as a form of digital asset. It's fast, convenient, and can be used anywhere in the world where internet access is available. It allows people to send and receive value without the need for banks. This peer-to-peer system means that transactions can be made directly between users without intermediaries, reducing fees and increasing transaction speed. Bitcoin is different from traditional currencies because it is decentralized. This decentralization is one of its most defining features, setting it apart from conventional financial systems that rely on central authorities. This means no single institution controls it. Instead, Bitcoin is maintained by a network of computers, known as nodes, that work together to validate and record transactions. Bitcoin operates on a revolutionary technology called blockchain. Blockchain is a distributed ledger technology that ensures all transactions are transparent and immutable. Think of blockchain as a public ledger that records all Bitcoin transactions. Every time a transaction is made, it is added to a block, which is then linked to the previous block, creating a chain of blocks, hence the name blockchain. This ledger is maintained by a network of computers around the world. These computers, or nodes, work together to ensure the integrity and security of the blockchain, making it nearly impossible to alter or hack. It ensures transparency and security within the Bitcoin network. Every transaction is visible to anyone, and the decentralized nature of the network means that no single point of failure exists, making Bitcoin a robust and secure digital currency. Bitcoin is a type of cryptocurrency. Cryptocurrency is a broad term for digital currencies that use cryptography for security. Cryptography uses complex codes to secure transactions and protect them from fraud. Bitcoin was the first cryptocurrency created in 2009. Its success led to the development of thousands of other cryptocurrencies, each with unique features. Some popular examples include Ethereum, Litecoin, and Dogecoin.